All right. Okay, you ready? All right, hold on. Okay. So understanding bond yields is actually a great way to understand how fixed interest works, right, Raza?
Definitely.
Yeah, so why don't you explain it to me as if I have no idea what you're talking about?
No problem. Let's say in a layman's term, like if you're looking at, imagine if you have a special bank, like a piggy bank, right?
Okay.
Called bond. So every time you put money in that bond, you get extra money by leaving your money in that bond, piggy bank.
Okay, so
Yeah.
all the money in the piggy bank and the money that you add to the money in the piggy
Yeah.
bank also makes interest
Exactly.
on the piggy bank money.
Yes. At the
Okay.
same time, if you wanted to borrow money, you end up paying higher interest rate
Out
for
of my-
borrowing money.
Borrow money out of
Yeah.
my piggy bank?
Borrowing money out of your piggy bank, you're gonna end up paying higher interest rate for borrowing. So if you are going to earn more money on your investment, but by depositing money, you end up paying more money for borrowing money. But if you end up getting less money on your investment, you end up getting less money to borrow money. When you're borrowing money, you end up paying less.
So the interest that you gain in your piggy bank, the
Yeah.
bond,
Yeah.
is a direct reflection on the interest you would pay if you had to go and borrow money from somewhere else.
Exactly. For instance, how bond relates to mortgages. If you wanted to borrow money on mortgages, if bond rates are high, meaning the amount that you're going to receive on your investment by investing in a short-term bond, like a 2-year, if you're getting more return on your investment, at the same time, the lending that the bank uses, they will charge you a higher interest rate at that time to lend money. But if the bond rates are down, and you look at a 2-year bond, the bonds are giving you less return on your investment. At the same time, if you go borrow money, the rates are going to be low on your interest rates.
So when bond yields are high, people are getting lots of money on their piggy banks.
Yeah,
The interest rates for borrowing money will also be high because it's the cost of doing business at a bank.
yes. So bond is related exactly to fixed rate mortgages. So if you really want to go out and time the market, study the bond returns, see what the bonds are giving. If the bond rates in today's market is high, you know it's going to be high interest rate of borrowing. But the bond yields are coming down, rates are coming down. You really don't have to wait for a Bank of Canada announcement. Bank of Canada announcements to do with
Variable rates.
variable rate mortgages, overnight benchmark rate that the Bank of Canada sets, and Bank of Canada sets their policy based on monetary policies.
Yeah.
And affects the entire economy, what the price index. So you can have to go in really good, deep research. What is Bank of Canada is thinking? The Bank of Canada is not controlling, but yes, of course, bond is issued by the Canadian government. So you're looking at the 2-year Canadian bond, 3-year Canadian bond, or 5-year. So that's what you're looking for, because bond is basically a loan that you're lending to the government. Right?
So a loan
the
you're
short-term
lending to the
loan,
government.
yes,
Yeah.
until the government is trying to get money as much as possible to reserve, but they're giving you return to borrow that money from you. But when they start giving you less return, that means they don't need that money, so they lower the interest rate on the bond return. At the same time, then you end up borrowing mortgages from the bank at a lower rate. So it has a direct impact. The bond has a direct impact on the fixed rate mortgages.
And so right now, if you were going to buy a home, what are bond yields and fixed rates doing today?
If I compare the data, it is coming down comparatively. Came down to close to 4%. So if you're looking at a 2-year bond that's trading less than 4%, around 3.8, bank always wants to make money at least a percent, 0.2 above the bond rate. So
Sure.
that is the prediction that you might end up getting the rate. But usually some banks, they buy the rate for 4 months, right?
Yeah.
So the average rate turns out to be a little bit more, but that rate can be negotiated too.
Yeah, so the smart money would go out and commit to a
Yeah.
fixed mortgage today because it's lower
Exactly.
for a short term because
Yeah.
all of the economic indicators are that the
Exactly.
Canadian government in the variable rates are trying to reduce inflation
Yeah.
so that the rates will come down and we'll
Yeah.
get back to that core benchmark 2%. Right?
Exactly. And then if you study more in the great research, in my opinion, I've been looking at it, the target the Bank of Canada is trying to do is majority of the mortgages are coming up for renewal. So what they're trying to do
2026, beware. 2025?
2025 and 2024. The reason they're not switching that rates right now is they want to control the spending power of the consumer. soon as these 2-year 2% rates, 3% fixed rates are up for renewal, they want their payments to double. So when the payments double, the consumer has less money to spend in the market. When the consumer has less money to spend in the market, now the gas prices, the inventory in the market stays in the shelf for too long. The retailers don't want that item. So instead of pricing it high, they have to price it low. So it has a direct impact. When you have less demand, more inventory.
It's the same with
same
selling
thing.
houses.
So they're trying to drop inflation. The monetary policy works to help to drop inflation. So when inflation goes up, Bank of Canada wants to control it, increase the monetary policy by putting it interest rate high. So the overall benchmark rate goes high to control the inflation. So it helps out, yes. Why not the rates not going down? Because the mortgages are not up for renewal. People that has been paying high interest rate, if you look at a variable rate mortgage holder, his cash power to spend in the market is less than compared to someone that is on a fixed rate paying 2%. He's blowing the money. He's enjoying standard of living. So when his mortgage of $1 million up for renewal, now $3,000 payment is going to $6,000. Now that $3,000 extra increase, he can't spend in the market.
So the other side of that coin is variable rates have traditionally always been the best performer.
100%,
right?
In my opinion, my favorite.
Me too. So I've always been on variable. And so what I did, you tell me what you think, is I got a long-term loan with a variable rate that allows me to double up payments every month. So I double up my payments, and I understand that that is how you can pay your principal down faster than getting a really big mortgage
exactly
and paying the commitment monthly.
The other option is when your rates are low, people that are already on fixed rate mortgages with low rates, increase your payments. Double up your payment, pay as much down to your principal, so when it's up for renewal, your amount of loan that you owe to the bank is lesser. And then at that time, you can also increase your amortization, because while you're paying down your mortgage or doing bi-weekly payment, doubling up and doing lump sum at the same time, you're decreasing your amortization. However, when you first took your mortgage at a 30-year amortization, it got registered at 30 years. But in 5 years gone, you're supposed to be at a 25, but all the lump sum payments that you did, it dropped to 18 years. So when it's up for renewal, you can renew at a 25-year because you actually have 25 years to pay back instead of 18. So that will also help you to reduce
your payment and pay double again.
Exactly.
That's awesome. Thank you for coming in today.
Thank you for having me.